All right, guys, let's do a non-farm payrolls preview. We've got an hour and a half, 90 minutes till the US deliver their final labour market report for 2015. I've got my charts here as usual. Well, let's come back to the charts in a sec. Let's bring up the data calendar first. As always, there's a load of data here. As is typical, as is always the case, the labour market report, first Friday of each month, carries a huge amount of information, loads of different angles of looking at the general health of the labour market. So it's always a tricky trading event for the simple fact that you're getting a lot of information dumped on the market at once. And so you can, of course, get confliction. So you can get some good elements to this report. You can get some bad elements that offset it. So it can be a tricky period to navigate through as a trader, as maybe you get confliction in the information. But let's go through all this info, and then we're just going to pick out really, well, for me, there's two pieces of information that are important, and the rest you can, by and large, ignore. Looking through this list, all this US stuff here, let me maybe just highlight this. All the stuff I've highlighted is the US labour market report. So the unemployment rate is expected to stay unchanged at 5%. Let's just have a quick look at that chart. This is the unemployment rate chart. We're down at lows that we haven't seen since the crisis. If I just extend that to a 10-year time frame, you can see really, I mean, maybe we're expecting it to stay at 5%. It's been there for a couple of months. It might go below 5%. And some people might say, well, that's symbolic, breaking below the 5% level. I don't think this is particularly important. I don't think the Fed, this is done. The Fed they've ticked this box. We have a return to somewhere near full employment. They've achieved this objective. You can talk about the types of jobs that are being created, and we'll talk about that in a sec. But for the unemployment rate, I think as a data point here, it's not that relevant. Even if it drops below 5%, which would be a new 6-year low, still, I don't think it carries too much interest. Back to the calendar. Then, of course, the non-farm payrolls number itself is the headline. And this is the number of jobs being created each month, both public and private sector. We've got a forecast of 200,000. This compares to the November reading of 211,000. Let's look at the chart. So this kind of data it's like it rescued the Fed in a way. The August and September prints, 153 and 145, the worst two consecutive numbers since 2012. And all of a sudden it was like, wow, the US economy is losing momentum. There's no way the Fed can hike rates, pretty bearish turn of events. But then we got rescued by the October figure of a massive 298 and backed up by a solid November reading at 211. Today we're forecasted at 200. Anything around expectations, fine. When you're thinking about this with regards to the Federal Reserve, as long as we're around 200, that's fine. They don't need 300,000 numbers like we got in October in order to justify hiking rates again. As long as payrolls is averaging around 200,000, that is good enough for them to go ahead and hike rates if the inflation conditions warrant it. Okay, what really happened with the rate hike in December is the Fed have basically said, we've achieved our mandate of maximum employment. We're now switching our attention fully to inflation. Now, in order to be able to keep their attention fully on inflation only, they need, of course, the payrolls numbers to show that the labour market remains solid. Okay. Of course, if we get a number down, let's say around the levels we saw in August and in September, around 150, well, it's almost like, the Fed are going to stumble right at the beginning of this cycle, this rate hiking cycle. What the Fed do not need is the labour market to just turn over and begin to weaken just as they begin their cycle of hiking rates. So it is an important number for the Fed, and as long as it's around 200,000, that's fine. They can keep their attention on inflation. If it drops to 150, well, they're going to get a little bit more cautious, perhaps, about the rate hiking cycle. Of course, any numbers that are 250 or above, well, then, happy days. More chance the Fed are going to hike sooner, i.e. their March meeting. So lots to think about. We're expecting 200,000. Also, don't forget, we'll get revisions to the last 2 months. So we'll get a revision to November's 211. We'll get a revision to October's 298. So, of course, in terms of importance, the headline December non-farm payroll number is the most important. And then the revisions to November or the revisions to October can be important if the revisions are significant. We could get large revisions higher, or we could get large revisions lower, or indeed, I guess we could get not much revisions at all. So do bear in mind and listen out for those revisions as well. But of course, it's the December number that's most important, 200 expected. Then we get a breakdown, where are these jobs being created? So we get a private payrolls, so that's how many jobs are being created in the private sector, and we're expecting all of them to be created in the private sector. None of those being contributed by the manufacturing side, but this means that the public sector is producing zero, okay? This isn't really a story. We've had this for years. So I don't think the breakdown here is particularly important. Unless you want to look at the manufacturing number, people are worried that the manufacturing PMIs have dropped. And, what does this mean for the manufacturing sector? If we get a really lowball negative manufacturing payrolls number, then, more concern about the health of that space. But I would say, by and large, other than the non-farm payrolls number itself, you're looking at the average hourly earnings number as the important news flow here. And there's 2 readings here, not only the month on month. So by how much did wages go up in December compared to November? We're expecting plus 0.2%. We then get the year-on-year figure. How much higher were wages in December 2015 compared to December 2014? Now, because of weakness in wage growth in December 2014, the year-on-year comparison here is expected to tick quite sharply higher to 2.8%. This is a 0.4% increase on the annualized reading. The important or significant thing about 2.8%, if it happens, is that's the fastest wage growth since before the crisis. Now remember, if the Fed are fully focused on inflation, what's a lead indicator towards future inflation? It's strong wage growth. So if you're trying to think, are the Fed going to hike in March, or are they going to hike in April, or are they going to hike in June? Well, the stronger this wage growth number is, the sooner hike number 2 will be, okay? Or of course, if this number comes in really weak, well, then you can push out that second rate hike expectation further into the, later on into the year, okay? So for me, payrolls, obviously number 1 importance. Don't forget to listen for the revisions, and then it's the average hourly earnings numbers, okay? I think you can pretty much demote all the other information to secondary importance. Let's look at the charts. And actually, before I look at the chart, one more thing to say. I didn't realize this. Somebody on Twitter here has got a long-term chart of payrolls going back 25 years, month by month. Apparently, this is the longest run of positive payrolls numbers ever. Well, certainly in this 25-year period, we've had 60 months in a row of positive payrolls numbers. You've got to go back to 2010 to find the last time it was negative. Look at these other periods. We had a decent run between 2004 and 2007, but we've beaten that. Look at the period between early 90s through to the year 2000, generally very strong, but every now and then we'd get a little slip below 0 here and there. So actually, 60 months in a row, this is very unusual and very consistent. This is why the Fed have started to hike rates, of course. But this is just an interesting stat. But by no means are we going to get a negative non-farm payrolls number here. If that were to happen, then wow. If you add that to the China risk, that could be a powerful double whammy right there. And this risk off maybe hasn't even started. the risk-off we've seen this year, of course. Let's look at the charts then, because we're in negative mode, definitely. It's been the worst starts of the year ever for the S&P, the worst starts of the year ever for Chinese equities. The S&P today nicely confirming this downward trend line. This morning we ticked up, we tested the overnight high at 1960, then we've just ticked off and we've come down. We haven't got back to the low yet, but it is an important low, the double bottom, 1931. The double bottom from yesterday's session, tested at the open of the Asian session today. So equities are, well, the S&P is, I guess, up on the day, but really we're absolutely still in this downward trending mindset technically. Europe is down on the day just, but certainly this risk-off scenario is still in there in the system. These are nervous markets, and so this data is important and can certainly trigger good reaction. Where are we going to see the biggest moves? So, you know, I think because the Fed have started hiking, maybe the sensitivity to this number has reduced slightly. Maybe you could say that. I think that the biggest movement would be bad news extending this risk off, but it's going to need to be really bad. I think you're going to need a figure that's below 150. You know, back to those levels I said that we saw back in August and September last year. Anything down around 150 or below is something the Fed are going to have to take note of, and it will make them more cautious perhaps, and they may well delay the rate hike number 2. So you're going to get some dollar weakness off that. Now with the euro dollar, which has been a tricky trade this week, with that euro dollar, we have got a key double top for the week. Monday's high, which was also the high yesterday into the close, up around 109.60. Okay, double top there for euro dollar. So euro dollar weakness off bad news could certainly get us up to test that key technical level. If you get weakness and we price out that rate hike and we get more risk off, well then bonds are going to respond positively to that. Prices will go up, yields will go down. Equities, you know, you still maybe got this double argument where bad news is bad news economically, so it's bad news for equity prices, but at least it delays the second rate hike, which you might say is good news. But I think that story is still there, but it's probably reduced somewhat. I think if we do get bad news, I think given the sentiment that's dominated market behavior this week, we'll almost certainly see equities move down off bad news, I would say. It might be a bit more tricky in that space, though. With regards to good news, you know, anything above 200 is absolutely fine. 250 plus, like the ADP employment report on Wednesday, if Payrolls comes in and backs that up with a 250,000 plus reading, well then, you know, that is really impressive and is going to reassure us that despite some bad economic data from the US, especially manufacturing, despite some negative elements, the labor market's still very strong. And that's ultimately the trump card. And we're going to see dollar strength. And, you know, we'll probably see equity strength as well, because it'll just be reassuring. And given the negative sentiment about China risk and China economic risk, a nice strong payrolls number from the biggest economy in the world will, I think, reverse this negative sentiment that's dominated global markets, and we should get a nice recovery, so some reversals of the week's losses. By no means are we going to rally back to 2,000 on the S&P. I mean, forget about that. I think we can reclaim some of this week's losses, but by no means all of them. So good news should see an equity rebound, a relief rally, if you like. But you're going to need something up 250 plus to get things properly moving. Final thing to say, you know, all this data gets dumped on us in one go at 1:30. Liquidity is going to be low. You're going to see the order book thin out dramatically. You're going to get algorithmic trading systems hooked up to this. So you're going to get what will appear like instant market reaction, which is just the algos, you know, operating at light speed. Don't get chopped up in the algo chaos of the first few seconds. There's nothing wrong with just sitting back, listening to all the numbers, taking into account all the information, then making an overall judgment. And there's nothing wrong with sitting back and waiting, you know, a minute, 2 minutes, 3 minutes, whatever. You know, trying to get involved immediately is a very dangerous business with the algos in the system. Okay, so there's never anything wrong with patience. This information can drive market movement for the rest of the afternoon. All right, so as always, keep risk tight, be careful. We've got an hour and 15 minutes till the news. For what it's worth, the Amplify forecast is, my statistician is about to give me the Amplify consensus view, which is 219,000. All right, so Amplify is bullish. I think I'm a bit dull on this. I think it's going to be somewhere around 200. I don't think it will be that significant a number, but you never know. Okay, guys, data in 1 hour and 15 minutes. Best of luck.